Now, prior to the extension of the lockdown announced by President Buhari, securities trading across the equity, debt and money markets had been done remotely. But let's talk about what the impact of the extension would have on the markets. And the head of research at United Capital, Wale Olusi, joins me now for some analysis. Good morning, Wale. Thanks for joining us. Well, let's begin with the president's speech and the extension of the lockdown. What does the extension mean for businesses and the markets generally?
Okay, good morning. Thank you for having me here. I think for businesses and the markets, it depends on the sector you look at. For those that are involved in manufacturing and many of these other sectors where their staff have to be physically present in their factories for actual production, I think this simply means that they are going to have another 2 weeks of zero productivity. But for some of us in the services sector, including the markets, the idea of working from home is now very has come to stay. If you ask me, for example, we have been working from home for close to 3 to 4 weeks now before the president, even made this announcement because we saw it coming. So for those in the services sector, I think working from home, depending on technological devices such as Zoom for meetings and all these other platforms, for trading activity as well as, for example, the banks, their channels. I think what you will just have is all of that will continue. But if you look at it on a whole, because a lot of people are going to be staying at home, demand will generally be weak, and then we will have productivity generally at a suboptimal level. But we understand that the economy depends on the health of the people. If you do not have healthy human beings, then the economy cannot thrive. So I think this is for the good. We need to ride the curve and allow a lot of people to those that are already infected show symptoms so that we don't overwhelm the healthcare system, and then we are able to handle it, and then we can get the economy back on its feet.
What are your expectations from the Ministry of Industry, Trade and Investment, Communication and Digital Economy, Science and Tech, Transportation, and other MDAs that, of course, the president has directed to jointly develop a comprehensive policy for Nigerian economic function with COVID-19?
I think that depends on the speed by which, that action point or policy statement will be developed, because a lot of things are happening and isn't just declared another 2 weeks. Because that's the policy rather than an action. The question is, are we going to have the outcome of that policy statement or action in the earliest possible period, say 1 or 2 days, so that this can be actioned immediately, and then you can palliate or reduce the impact of the lockdown and of course the COVID-19 outbreak on economic activity. But I think we are more excited about the agricultural bit of the statement, where the president mandated the Ministry of Agri to also work with the Presidential Task Force to ensure that the impact of the pandemic is minimal on agri, so that people can continue to feed. And by the time we are done with this, people can be back at work, and we can reduce the hunger.
Now, let's actually look at the market side of the lockdown extension. Now, how do you expect traders, dealers and treasurers to trade the directive, of course, bearing in mind that they're just resuming from the Easter break, even with the lockdown?
Well, I think for the market, we think there's a little bit of positive headline that happened over the weekend. This problem started because the coronavirus outbreak, a huge weakness in demand, especially coming from China, and then it filtered all over the world. But a huge proportion of it is also caused by the fallout of agreement between OPEC and non-OPEC members. That's also led to a supply overhang in the oil market. So prior to last week, what we were battling with is a situation where the coronavirus pandemic led to demand shortfall, and then the fallout of agreement between OPEC member, resulted in a complete collapse of or an overhang of supply. But what has happened over the weekend, whereby we saw a deal between OPEC and non-OPEC member, as well as US, Mexico, and a few other countries, that has resulted in about 13.2 million barrels reduction in supply starting from May. I think this is a very positive information that will address at least a part of the problem. Whether this is enough or not is probably not the issue now, but the fact that at least it takes care of some level of, one of the aspects of the problem in the market. We think, that will create some level of stability in the oil market. Oil prices will probably stabilize between 30 and probably 35 as a result of the OPEC deal. And then we'll now have to battle with demand shortfall, which can last up until the medium term. But I think the story coming from the oil market and the OPEC deal is positive for the market. As of last week, we've already seen the equities market rallying ahead of the excitement of an agreement for the deal. We also saw Eurobond prices retrace slightly upward. So we think this week that excitement is likely going to greet market going forward. But whether that will be sustained now depends on how fast countries around the world can, quickly come out of this lockdown. And from the projections we are seeing, that might take a minimum of 2 to 3 months from where we are.
What about FPIs now? How would this lockdown, or how would they react to the lockdown extension?
I mean, for many of the FPIs, what we've seen is that most of them have already exited the market. They were heavily exposed to central banks' open market operation, OMO bills, before now. When the pandemic hit hard, an OPEC agreement fell apart about 2 to 3 weeks ago. What we saw was a huge sell-off to the banks of their OMO position, and of course their equity position as well. We think with the lockdown, what they would do is to continue to watch, allow a lot of stability to come back before they start looking at us. Now, most of them are currently running to safety, investing heavily in US Treasury bond, probably gold, and probably Japanese yen, basically looking at safe assets. For them to look at countries like Nigeria and many emerging and developing or frontier countries, we think we would have to see stability in the system that is much more than what we currently have.
We saw a bullish run last week across the markets. How sustainable is that sentiment this week?
Well, we don't think it's very, very sustainable, but I think it will result in some level of recovery in the market. Compared to where the index level fell to last week, something close to 20,100 points. We've seen a recovery back to 21,000 points. We think some buying interests will come in this week. Then what you will have thereafter is a situation whereby people realize that these asset prices may not fall below the levels they fell about 2 to 3 weeks ago. And then people will begin to hold on, hoping that this pandemic will be resolved within the medium to short time period, so that they can take advantage of valuation in the market when asset prices eventually rebound. So we think it will stoke investment sentiment this week, but going forward, you might not see the momentum sustained until we now see more positive news in the market, especially around maybe if the US reopen its economy, just like President Trump was saying, maybe in May, or we start seeing strong recovery or reduction in the number of cases of those that are infected by the coronavirus. Yeah, maybe once that comes up, we'll now see improvement in demand across the market.
The government has indicated plans to intensify domestic borrowing. How are dealers bracing up for that?
Government has sensitized Sorry, I didn't get that. Can you come again, please?
How are dealers actually bracing up to the fact that the government has indicated plans to intensify domestic borrowing?
Oh, I mean, for the domestic debt market and the fact that governments want to intensify, I think dealers are probably going to be indifferent. We've been buying, and the big issue is that for treasury bills, the interest rate has been considerably low. We've had pension fund and a lot of institutional investor, continue to pile up buying that. An increase in demand for government will definitely lead to, probably some level of increase in rates in that segment, maybe about 1 to 2%, which will improve returns generally. But, give or take, dealers will continue to buy. They don't have a lot of options. Most of them don't want to be overly exposed to equities or assets that are considerably risky. So I think they will take advantage of it. But the biggest challenge for them is that those rates may not really justify the risk in the horizon. If you look at inflation rate at about 12% going towards 13, and then if government is going to intensify borrowing, they are probably going to do it at a little premium from what rate is currently. So which will still be, at a net negative real return for many of these dealers. So you ask me if they will be excited, maybe not. But will they buy it? They really don't have any choice. They will buy it.
Now, there is an OMO primary market auction this week, and there's also the Dangote Cement 100 billion naira bond issue in the works. Your commercial paper is also open, as well as that of Nigerian breweries. How sufficient are these raft of offers for the current system liquidity?
Well, I mean, I think system liquidity is huge. Don't forget that before this health crisis, coronavirus pandemic, late last year, the central bank crashed interest rates. They dichotomized the OMO market and started selling OMO to only banks and FPIs, or foreign portfolio investors. So we've had a lot of liquidity in the system. And we continue to see a lot of OMO maturities, that continue to push liquidity in the system considerably high. So, I mean, I think liquidity in the system is going to remain high. And then people or investors generally, especially the institutionals, will continue to take advantage of whatever is in the market to buy them. That's partly one of the reasons why rates will also continue to stay low, because investors don't really have too many options. Again, many of them will continue to take advantage of the corporate papers that are being issued. Like you mentioned, the Nigerian breweries CP. We did a CP recently as well. Dangote corporate bond is also out. Those corporate papers will offer rates that are slightly higher than what the sovereign, the government, is offering. So you will see a lot of interest in as a result of the yield environment, especially as far as treasury bills are concerned.
Head of Research at United Capital, Wale Olusi, thanks for your thoughts this morning.